Hello traders, welcome back to your FXCM YouTube channel. My name is David Londoño. I'm a trader and I also do market analysis. And in today's video, we're gonna be doing a brief introduction to financial derivatives. Now, financial derivatives are financial instruments whose value is derived from the value of an underlying asset, index, or rate. So they are used for various purposes, including hedging risk, speculation, and arbitrage as well. So here is an introduction to the basics of the financial derivatives. Let's start with the futures contracts. So its description, a future contract is an agreement to buy or sell an asset at a predetermined or a predefined price at a specific time in the future. So commonly used to hedge against price changes in commodities, for example, oil or gold, and also financial instruments, for example, currencies and bonds, or even stock indexes. Then we have the options contract. This is the second kind of derivatives. An options contract gives the holder the right, but not the obligation to buy. So that's called an option. Or sell, it's put option, right? An asset that predetermined price before or at expiration. So it is used for hedging, speculation, or income generation through options writing. So investors can manage potential risk or leverage positions with limited upfront costs. The third kind of derivative is the swaps. So a swap is an agreement between two parties to exchange cash flows or other financial instruments over a specified period of time. So the most common type are interest rate swaps and currency swaps, and they are used to manage interest rates exposure or currency risk. For example, a company might use an interest rate swap to switch from a variable interest rate to a fixed rate. That's the third kind of derivative. And the last one we have for you today is a forwards contract. So a forward contract is similar to the futures contract, but is traded over the counter or OTC rather than on an exchange. So it involves an agreement to buy or sell an asset at a specific future date at a price agreed upon today, right? So it's typically used for hedging purposes by businesses and financial institutions to lock in prices for rates. If you want to know more about them, I will recommend you this article on our FXCM platform. It's called Derivatives. Here you can find everything you want and also to learn at your own rhythm. And I want to also recommend you the stocks versus derivatives, which is right for you, because on this article you can understand which works better for you and your strategy and your type of management of your own. So that will be all for this video. I hope you like it. Don't forget to share and subscribe, and I will see you on the next trading session.